Hello, and welcome to Portfolio Matters, weekly markets checklist, week 185, and an incredibly dramatic week in the world economy and in markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, it's been an incredible week in the markets, a week in which the market finally came to the realization that Donald Trump was very serious about tariffs, and that led to huge gyrations. So just to go through what happened this week on a day-by-day basis. On Monday, equity and bond markets across the world fell sharply after China retaliated against US tariffs and fears of a global trade war grew, and that continued on Tuesday. On Wednesday, the sharp falls in US bond yields essentially forced Donald Trump to blink. As we said last week, the markets would force Trump to reverse policy, and that's exactly what happened. He suspended retaliatory tariffs on all countries except China, leaving tariffs on most countries at 10%, but he raised tariffs on China to 125%, and then China retaliated with tariffs of 84% on American imports. The reduction in tariffs saw our markets recover sharply, but then on Thursday, Trump announced retaliatory tariffs on China would rise to 145%. And markets slipped back, dollar resumed its falls, and investors continued to flee the US. On Friday, the bond sell-off continued, but equity markets recovered some poise. China imposed tariffs of 125% on US imports, so the trade war continues. And then on Saturday, Trump realized that his tariffs would basically cause the collapse of the US electronics industry, and he exempted them from the reciprocal tariffs, leaving tariffs of just 10%. But since then, the Trade Secretary Howard Lutkin has said that the reduction in tariffs for consumer electronics in the US would just be temporary while they sort out category related tariffs. So they're talking about tariffs on pharmaceuticals, so they're talking about special tariffs on pharmaceuticals and electronics, etc. Okay, so wider news. So Wednesday, Trump suspended retaliatory tariffs on all countries except for China for 90 days in response to the bond market turmoil. But his higher tariffs on China mean that actually overall tariffs have gone up. So although he's reduced retaliatory tariffs to 10% on most countries, because he's raised them against China, the average tariff charged by the US on its goods imports has risen. China retaliated with further increases on tariffs on the US, and they're now 125%. Europe, though, suspended its retaliatory tariffs on the US while it seeks to negotiate a deal. It has warned that it may impose a tax on digital services if it fails to make a deal. Reminder, the EU exports lots of goods to the US exports lots of services. So trade between the EU and the US is relatively balanced. And as we talked about last week, Donald Trump's fetishization of goods imports ignores the US strength in services exports. There was very little economic data this week, so we will be leading with markets data. US inflation came in soft, and it was a really good inflation report. Inflation came in at 2.4% versus expectations of 2.6%, but obviously tariffs are forecast to cause US inflation to hit to 4% later in the year. The Michigan survey of consumer sentiment for April came out, and preliminary numbers show a further plunge in consumer confidence and a further rise in inflation expectations. Not a good combination. So the Fed is going to have to keep rates higher for longer to stop inflation expectations, causing a resurgence in US inflation. The great news for the UK is UK GDP for February massively beat expectations, coming in at plus 0.5%, and January was revised up from minus 0.1 to 0.0%. So the UK economy continuing to prove resilient. Overall this week, bond markets plunged as investors lost confidence in the US and US inflation. So yields soared. The UK was caught up in that. UK long bond yields hit their highest since 1998. In contrast, bond yields in Europe fell as investors chose the Eurozone as a safe haven and fled the chaos in the US. So the dollar plunged against the euro, equity markets recovered some ground, oil recovered a bit but remained depressed, gold soared, particularly in US dollars as the US dollar plunged. Some charts relating to the news. Well, China's largest export to the US is consumer electronics, and that has now been made temporarily exempt. But a specific tariff regime for electronics is coming, according to, as I've heard his name put, Nutlick. So, although Donald Trump has suspended retaliatory tariffs on most countries, because he's raised tariffs on China, the average tariff has actually risen to new highs. Bond markets really don't like the chaos. They've lost confidence in the US. And instead of bond yields falling as equity markets plunged, bond yields have risen in the US. And the sharp drop in US bond yield prices was exacerbated in foreign currencies as the dollar also plunged. So it appears that investors are fleeing the US. The US is losing its safe haven status. And an aspect in that plunge in bond prices in the US is an increase in the sovereign default risk, which has risen sharply. Now, obviously, it's very unlikely for a country to default on its domestic bonds, but as we've talked about previously on the podcast, it has happened in Jamaica in the 1980s. So it's more likely that the US would simply continue to pay its debts in devalued US dollars than actually default. Foreigners own huge portions of US bond and equity markets. So if they continue to flee, there could be a lot more selling to come. Foreign central banks sold US equities heavily last week. And all that turmoil has led to a rise in US credit spreads, but they're only really back to normal levels. The credit market is not saying there's going to be a recession in the US. If it expects that, credit spreads will rise a lot further. And credit spreads are lagging a long way behind economic policy uncertainty. Normally, they're quite well correlated. That suggests that corporate bond spreads have a lot further to rise if chaos continues. And although the US economy is holding up quite well at the moment, that could well be because of temporary effects such as people buying goods everywhere, including iPhones, to get ahead of tariffs. Tariffs will take around 3 months to really have an effect on prices because retailers everywhere have stockpiled. And even in Europe, credit spreads have widened sharply. Rising swap spreads indicate that financial counterparties are charging more to lend to each other. That's not great. And the yuan has not devalued against the dollar. Now, it had, because the dollar's weakened, the yuan has devalued against sterling and the euro. But so far, China has not exacerbated the trade war by devaluing the yuan against the dollar. It could yet. But against sterling, the yuan has hit new lows. Now, that is deflationary for the UK and for Europe. US small businesses are going to be hit hard by tariffs. Many will fail. This is something I saw where this is a small business in the US, and this is before Trump raised tariffs to 125%. This is when they were 85%. It imported a small aluminium part worth $3,380 and then hit by import duties of $2,480. Now, this is going to massively hit small US manufacturers who source all their components from the US. The uncertainty index, we thought it was high before. It's absolutely exploded, and measures of market stress have also risen very sharply. Bid-ask spreads have exploded in the turmoil. That's very good for hedge funds and investment banks as turnover went through the roof. And when we think about what US consumers are thinking about all this, well, during the University of Michigan monthly survey, they got a lot of unsolicited negative comments about government economic policy. 60% of respondents spontaneously made negative comments about Trump's economic policies. And finally, and this is not something we really want to think about, the US has sent 6 B-2 stealth bombers to its base in the Indian Ocean and a second aircraft carrier to the Gulf. And Donald Trump has warned Iran that if they don't stop supporting the Houthi rebels and end their nuclear weapons program, he's going to bomb them and give them the bombing the likes of which have never been seen before. He's difficult to control. Will he actually do this? This is from the Tax Foundation, and this is an estimate of how the Donald Trump's tariffs will impact the US economy. So the average tariff rate on all imports will rise from around 2.5% in 2024 to 16.5% now. Imports, they estimate, will fall by 25% to 800 billion. Over the next decade, the tariffs will raise 2.9 trillion. Obviously, all of this can be revised very quickly because he changes his mind over any day of the week. They will reduce US household income by about 1.9%, and that amounts to an average tax on each household of $1,900. Tariffs will reduce US GDP by about 0.7%, and retaliatory tariffs will reduce GDP by a further 0.1%. Tax revenues will increase by about 260 billion, or 0.85% of GDP. That is the largest tax hike since 1982. Our thoughts. Well, we are in a prolonged trade war that will damage the world economy. External conflict benefits dictators as it unifies the country behind them and distracts them from domestic woes. So, Donald Trump seems to be enjoying this, and China will be enjoying this. As an aside, I've been reading The Three Bodies Problem, the Chinese sci-fi novel. And at the end, the author gives an epilogue to talking about his own life. So he grew up in the Chinese countryside where it was so cold that the children would have frostbite and they would have injuries from frostbite. And this is all within our lifetime. So the Chinese, they're tough. They've experienced real hardship in the last generation. The thought that they're going to back down in the trade war with the US because they fear some economic hardship is just delusional. They will sit this out. Compared to the US, which has the richest, most pampered population in the world, the US will blink first, and they're a democracy. So conflict with the Americans suits the Chinese Communist Party. They will not be backing down. The world economy and the global monetary system are in trouble. Richard.
Yeah, so, I mean, thank you, Keith. It's very succinct. Long but succinct. Long because there's so much going on. Succinct because it was brief. Summary of what's happening, very useful. I mean, basically, he's thrown all the pieces up in the air, hasn't he? And he's just waiting to see what happens. And then he's reacting to what happens. And it is chaos. It's complete chaos. And I mean, the reason clearly the flight into gold is because people recognize that it's chaos, and they don't know where else to put their money, because they don't know if the stock market's going to plummet or soar. They don't know whether treasury yields are going to plummet or soar. No. And so people are looking for what they consider to be something that Trump basically his actions can't influence adversely. What is the outcome of all this going to be? I think there are far too many moving parts to predict, but it is utterly chaotic. I don't think he particularly, he's just started his 4-year term. He's not eligible for re-election. I don't know whether he really cares whether the Republicans are re-elected at the next presidential election or not. I presume he cares about the midterms, because that will be important on his ability to push through other things. But he's just chucked everything up in the air, and he's waiting to see. He did it with Doge, and the pieces with Doge are slowly falling back to earth, very slowly. Yeah. And he's done it with this. So this is obviously much more systemically important. My concern, I suppose, with it all is that the world economic system is already very fragile. It's already in intensive care, and this is totally destabilizing of that. Now, whether his rapid reduction, his rapid apparent climb down in tariffs was because he's concerned about some systemic breakage of the system, or whether he was always planning to sort of smack everybody around the chops and then step back a bit, who knows? I just think it's what element is being forced on him, what element is it's just total chaos. Yeah. I think the EU have done the right thing. I think going up against him and fighting him, it's playing him at his game, and you can't play him at his game. He's got too much power, and he's too unpredictable. You have to play your own game. But we're definitely going to be seeing the fracturing of the world into, I suspect, 3. Yes. There's the Chinese centric, there's the US, and then there's everybody else. Yeah, no, I agree, Richard. And we have got a segment coming up on legal challenges to the tariffs and their legal basis. And spoiler alert, it's going to be difficult to challenge them. Yeah. And there's a lot of challenges in the US political system, legal system, aren't there, against Doge and the cuts and so forth. Yeah, I think Trump views them as sort of ticks on his back. He won't be diverted by them. Well, he seems to he seems to enjoy just the attention and the fact everyone has now come flocking to him. Yeah. And not just foreign governments, but also US corporations. Apple has to come running to him and say, can you remove the tariffs? Otherwise, we're going to go bust, Yeah. And it's part of this, chuck it all up in the air, see what happens. But it's very dangerous. It's a very dangerous thing to do. Yeah. Because the consequences are totally unforeseeable. So we think this is a political crisis as well as an economic one. So Trump has imposed these tariffs using his executive powers as president without the approval of either the House of Representatives or of Congress. Now, when Liz Truss enacted a ruinous budget in the UK, leading to a similar crisis in government bonds, she was swiftly removed by her own party. Now, in the US, there is no similar route to remove the president. In order to do that, you would need to pass an impeachment act, which would require 2/3 of Congress.
Now, it would require an extraordinary crisis to get that much political consensus in the US, and we are nowhere near that yet. The bottom line is the US Constitution gives the president very strong powers, and as a result, he is very difficult to thwart. The chaos will have to get a lot worse before there's sufficient resolve to solve it.
Mm.
Any comments, Richard?
Yeah, I mean, I think without being an expert on this subject, the US presidents have, over the past, it feels to me, 15 years, have started to push the boundaries of executive orders. And Trump has pushed the boundaries even further. And the problem with that is I don't think that the US Constitution ever foresaw that an executive order would be used anything other than an emergency. And actually, it's being used as a commonplace way of forcing through policy. And it's actually identifying a weakness in the US Constitution.
Absolutely.
I don't know how they address it.
Yeah.
Certainly can't address it during Trump's term unless, as you say, takes very dramatic action, which he's not in a position to do at the moment. So,
well, the bottom line for me is this chaos is going to get a lot worse.
I think so.
Equity markets recovered a bit. I think that's just wrong. I think where you are in gold, Richard, is gold and cash are the logical places to be. This is going to get bananas.
The other problem is what's the impact going to be on inflation? And I'd be interested in your view on this, Keith, because obviously the price of oil has dropped to an extent, but then you've got the impact of the tariffs, and I don't know where the equilibrium settles out on that.
Well, the US is very different from the rest of the world. Because the rest of the world actually has not imposed tariffs, and they still represent around 83% of world GDP on a purchasing power parity basis.
Right.
So, although the US is removing itself from the global trading system, the rest of the world is likely to increase trading between themselves. And so, in the case of the US, tariffs are absolutely going to cause a rise in inflation. The problem for the Fed is they have to keep interest rates high to stop that one-off inflationary surge turning into a longer-term inflationary problem, as it did, let's say, in the 1970s, when you had a one-off rise in the price of oil, which led to ongoing inflation. You can't let inflationary expectations feed through to higher inflation. Now, in the US, we will show you that the latest consumer survey data shows very strongly that US consumers are expecting inflation to rise sharply. Now, the danger in that is if you expect prices to be higher in the future, you start spending now, and therefore you create a self-precipitating inflationary surge. And so the Fed has to lean against that. Now, in the UK and Europe, I think this is deflationary. We've had UK retailers warn this weekend in the FT this morning about dangers of a flood of cheap Chinese goods being diverted to Europe and the UK because they can't get into the US anymore. That's deflationary for goods inflation. And also you've had sharp falls in the oil price and in the natural gas price. Now, last week, we'll take you through the data. The oil price recovered a tiny bit. Natural gas continued to fall. So actually, this is all disinflationary for the UK. But for the US, the US is the most powerful monetary and economic force in the world, and they are shooting themselves in both feet. Richard.
Yeah, so that's interesting, Keith. And particularly interesting about the inflationary impact on the UK as a domestic issue. I also, I don't think Trump. You see the charts of the treasuries. You see the foreign central banks removing themselves, selling down US equities and so forth. I don't think Trump cares. I think he has chucked, as I say, he's thrown everything up in the air, and I think he's also thrown up Wall Street and the what happens there. I think that he's thrown that up in the air as well, and I don't think he cares where. At the moment, he might well care one day, but right now, I don't think he cares. I think he's waiting to see what happens, and so the problem with that, of course, is that he can actually break it completely because he doesn't care. And he doesn't care sufficient, or he doesn't understand sufficiently to know that the thing can actually be fundamentally broken in an irreparable way that basically destroys the world's financial system. So I think that the real danger is not the sort of trade chaos and so forth, which clearly is a danger, but the real danger is that he actually breaks the global financial system without realizing it.
I think it's worse than that, Richard. I think he's actually enjoying it. I think that, so during all this chaos, he went golf. He played not just a round of golf, he played a golf tournament last weekend. And the thing is, I think this makes him feel really powerful.
Yeah.
And, I expect it to continue until somebody stops him.
Well, interesting. Oh, and here we have, yes.
So it will surprise you to learn.
That was an unplanned segue, but quite neatly
done. It will surprise you to learn that Rich and I actually belong to a book club where we have been reading the plays of Shakespeare. And in Richard II, Henry Bolingbroke is being sent into exile. And Richard II decides on a whim to cut his exile from 10 years to 6 years. And at the end, Henry Bolingbroke says, "Such is the breath of kings." In one word, he can just change anything because there are no checks on his power. He's a tyrant, is the point of the play. And what Donald Trump is doing is exactly the same. Such is the breath of kings. In one moment, he can impose 125% tariffs on China, and there are no checks on his power. And this week, because there's very little economic data, we're going to lead with equities and market data. Richard.
Thanks, Keith. Huge amount of volatility in the equity markets. So pretty much, I think, all of them are down year to date. The biggest down year to date is the Russell 2000, and the next biggest is the NASDAQ. But the weekly changes mostly up last week. So the FTSE All World was up 5%, and the FTSE All Share was down 0.9%. Stocks Europe was down nearly 2%. S&P 500 back up nearly 6%, and the Russell 2000 up 2%. NASDAQ soared and reduced its loss for the year by 1/3, up 7%. Hang Seng up 7%. And the topics up 8%. Even Bitcoin had a bit of a revival at nearly 10% on the week. And as Keith mentioned, the pound was up 1.7% against the dollar. Euro was up 3.5% against the dollar. The dollar index down 3% at below 100. And the VIX fell last week, although it's up nearly 120% year to date. So that's the FTSE World Index. The FTSE All Share.
Yeah, interesting. So the All Share has really not bounced anywhere near as much as the All World.
Yeah, and the Euro Stoxx 600 looking like the All Share, FTSE All Share. S&P 500.
Yeah.
NASDAQ Composite. I think the question from all of these is, have they started moving into a prolonged downturn?
Honestly, I think they have. As long as this chaos continues, equities, you need stability, and everything he's doing is going to be reducing US corporate profits.
Yeah, I think you're right, Keith. The Russell 2000.
Yeah. See, the Russell 2000 reflects the US economy as opposed to growth and tech. And
Yeah.
it's saying the situation is poor.
Yeah. Hang Seng.
Now, this is surprising, isn't it? China meant to be really suffering from the tariffs,
Yeah.
best performing market of the in the world.
And there's the topics. Bitcoin.
Bitcoin is actually proving to be a safe haven.
Yes.
Shocked.
So I said John Paulson. I read a quote the other day. John Paulson described Bitcoin as a limited supply of nothing.
Yes, that's very good. I agree.
I thought it was very good.
Yes. Go on.
There's the pound against the dollar, which is in quite a strong uptrend, as is the euro against the dollar, with a big spike last week. The dollar index down below 100, as I said earlier.
Yeah,
That's where Trump wants it to be.
Well, he's succeeding.
And so the US dollar hasn't weakened against emerging markets.
Yeah, this I thought was really interesting. So, emerging markets obviously have are very sensitive to the dollar because they've got lots of foreign borrowings and debts to service. And the dollar has weakened. Basically, there's been a flight to safety in the euro and actually even in sterling.
Yeah.
But the value of, let's say, developed world currencies versus the emerging markets has not changed.
Which suggests that those currencies are under pressure from the tariffs.
Mm, yes.
There's the VIX, which had a huge spike and has fallen back off some of that spike.
Yeah. Expect VIX to continue high.
Yeah. And S&P 500 earnings forecasts are continuing to fall, as they
Yeah.
have been actually since December. Still hugely optimistic, aren't they?
I mean, this just seems, they haven't worked it out yet.
No.
US corporate profits are coming down. They're not rising next year. They're coming down.
Yeah. And credit spreads have widened, but there's not a great sign of distress there.
You see, I think if tariffs continue, there's going to be distress.
Yeah. That little quote that you gave by the company that imported the aluminium parts, expecting to pay $3,000 and effectively having to pay $5,500.
Yeah.
That's crucifying for small businesses,
Yeah.
which I think Trump simply doesn't understand.
Well, the other thing is, Richard, let's say you're that aluminium part producer. Right now, if you were to import that $3,500 part, you would be paying what, $4,500 in tax.
Yeah.
Now, you also know that, next week it could be zero, it could be 10%. So what are you going to do? I would suggest what you're going to do is stop ordering altogether and see what happens.
Or and the other way of addressing it would be to say to your customer, this is the price you'll have to pay plus whatever the tariff may be, and try and pass the risk on to your customer. But of course, your customer then is going to be in the same position you've just described, which is, well, I'll sit on my hands, thank you very much.
Yeah, exactly. Let's wait and see what happens.
Yeah.
So I think for a while, companies will be working through inventory, but I think there's going to be a sudden stop.
Yeah, I think you're right. This is interesting. 6 charts showing different methods of valuation in the US stock market, and all of them are still, despite all the chaos and turmoil that we've had, all of them are extremely high.
Yes.
Price for perfection. Bear market rallies, hard and sharp and perfectly normal. And as I think Keith and I both think, this current rally is a bear market rally.
Yes, I very strongly think that actually. The chaos is just really bad for companies, for all financial assets are super bad for them.
Yeah. US equities below their average valuation over the last 10 years, but still very highly valued.
It's still very highly valued. Agree.
and investors have suddenly become bearish
Yeah.
from, well, you can see retail. There is a lot of retail buying. So buying the dip, wasn't it? Retail
Yeah.
buying the dip fantastically.
Yeah.
But
Reflexive, I'd say.
well, it's worked, hasn't it? Over the past, well, since the GFC, really,
Hmm.
as a strategy.
Well, I think the big difference this time around is Fed's hands are tied. Fed can't come in and save the US bond market, and it can't come in and save equities because it can't do any monetary stimulus because you've got an inflation problem that's self-inflicted.
Yeah. And you also wonder whether it wouldn't actually suit Trump's purposes to do away with the Fed and simply have the US Treasury take on the policy.
Yeah, well, that would be absolutely fatal for US bond markets and fatal for the solvency of the US, which has debt to GDP approaching 100%. So you would have a solvency crisis in the US.
So this is suggested a recession, bear markets where there isn't a recession, and currently there isn't a recession in the US, are very unusual.
Yeah.
Of course, there may well be a recession in the US in due course, as we've alluded to, but right now
Yeah.
there
But
isn't.
also, this is about the discount rate rising because of so much uncertainty.
Yeah,
When you buy an equity, basically buying a cash flow from the company, from corporate earnings. And does anyone know what that cash flow is going to be? Tariffs are going to massively impact what your profits are. You just don't know. So in a rational market, the price you're willing to pay for that cash flow has fallen.
yeah, completely. So deficits are bullish for corporate profits, and obviously, and budget surpluses are bearish for corporate profits because there's less money going into the economy, and so the potential unintended consequences are by cutting the deficit, he also cuts the rate of growth of the US economy. Which is actually it's a dilemma for every highly indebted country: is how do you get rid of the deficit without screwing the economy?
Yeah. So one of the things that happened this week, which has been lost in all the noise, is the House of Representatives attempted to pass a budget resolution and failed because 20 Republicans, 20 fiscally conservative Republicans, refused to pass the bill. So he is getting some pushback on, unfunded tax cuts. And I'm wonder whether that is the start of some resistance to his agenda. Let's see.
Yeah,
And on to commodities. Thank you, Richard. And quick summary: energy, oil bounced a bit. Natural gas continued lower. Industrial metals generally bounced from their lows, except for tin, which totally collapsed. Precious metals, congratulations to Richard and everyone in gold because it had a fantastic week. Okay, so energy commodities. So Brent bounced 1.9% to $65. WTI up 2.5% to $62. Still down 13% on the year, disinflationary. Dutch natural gas continued to fall, down 2.3% on the week, down 33% on the year. Great news for the European consumers. UK natural gas prices also continued to fall. Great news for us. US natural gas prices also fell and are down 4% on the year. Coal continued to fall, down 24% on the year. Obviously, Trump is attempting to support US coal miners. Let's see what happens. Uranium, flat. This is Brent. It seems to have found a new bottom. Reminder, in May, OPEC starts to open the taps. I see little prospect of a rise in oil prices. This is WTI, the same. Numbers specific to the oil market. Well, over the past week, there's a crude build in inventories in the US. So the US market seems well supplied. Crude production, though, actually fell by 120,000 barrels a day. And as you might expect with a falling oil price, crude drillers have started to take rigs out of the shale patch.
So when this happens, sorry, Keith, when this happens, is it that the well is drilled, the rig is taken away, and their rig isn't reused, or is it that they actually stop drilling?
So there's loads of the oil service companies have lots of these rigs available for hire. So when it's taken out of service, it just goes back to them. They don't drill. You're not going to drill another well until oil prices rise. And historically, you've had over 1,000 wells in operation. So there are a lot of drilling rigs in inventory. Now, many of those will be old, but there are many available. So this means basically that they've stopped drilling. And it takes about a year for a well to come into operation after it's been drilled. So that is not going to have an immediate effect, but medium term it will.
So I think it's very interesting because there is a view that there is insufficient exploration now to sustain this 100 million barrels of oil production, consumption a day required that appears, it's not reducing, that to sustain that level of production, for example, in 5 years' time.
Yes.
And that therefore is a reason to start slowly reinvesting in the energy, in the oil, fossil fuel sector.
Yes. Well, I totally agree with that, Richard. But if the bottom line is OPEC spare capacity is now at a high, and they are fed up with it, and they are going to start increasing oil production by 2.2 million barrels over the next year into an already weak market. You don't know how low this can go. Now, when oil prices do crater with an extra 2.2 million barrels a day coming into a world economy that is weakening, you could see oil coming down to $50. But then, as you say, the oil cycle returns. And I think the next oil cycle is going to be an absolute doozy because as you say, we've been doing no exploration and we've been relying on US shale to provide marginal world oil production growth.
Yeah.
And US shale in most of the basins has peaked and is now flat. Only the Permian has spare capacity, and that is also slowing. So in 5 years' time, you're going to be looking for growth, and there ain't going to be none.
So the thesis is basically gradually move yourself into oil, but don't be in any hurry because you think the price is going to drop once this additional pumping by the Saudi comes on stream.
Yeah, and you see that next month they were due to increase by 130,000 barrels or something, and they're doing 411. So they're all getting fed up. They're being fed up with other OPEC members, particularly Kazakhstan, cheating, and so they're fed up with taking the pain to support the oil market. So this is EU natural gas, still down. That's great for consumers. UK. Now, what's happened over the past week is that China has imposed tariffs on US imports. So US LNG cargoes that were actually en route to China were cancelled mid-voyage. And they now seeking other destinations. And so possibly to Europe or India. But that means that there's no shortage of LNG.
So just again, Keith, sorry to interrupt you, but one of the things I find interesting now is obviously the British government's just taken over effectively the Scunthorpe blast furnaces. Yeah. And one of the reasons the Scunthorpe blast furnaces are losing so much money is because of the ludicrously high price of energy for industrial users in the UK. And now the government is going to have to pay that price. And I think there's going to be an incentive for them to sort this mess out, because they're going to be sort of being punched on the nose by this every day.
Actually, I disagree with that. Because the thing is, they're blast furnaces, so
Yeah.
they use coking coal. Yeah. If
Mm.
if they turned them into electric arc furnaces, which was the original plan, they'd be paying the idiotically high UK electricity prices. But actually, they have gone against the green agenda, which is,
Well, they have indeed,
interesting.
haven't they? I
Yeah.
think Ed Miliband was threatening to slit his throat, wasn't he? But I think he...
Oh, okay. Suddenly we get very excited. So that's politically incorrect. Never mind. Moving swiftly on.
Yes.
Coal. So this is it. The price of the coking coal going into your Scunthorpe Steelworks coming down. Uranium flat. On to industrial metals, Richard.
Thanks, Keith. So for the mixed week for industrial metals, actually a mixed year to date for industrial metals as well. So aluminium up 1%, cobalt down very slightly, but up nearly 40% year to date. Copper up 4% and up 13% year to date. Iron ore down marginally this week and last week and year to date. Lithium down a little bit last week, 1.4% and 4.6% year to date. Neodymium almost unchanged on the week, up 12% year to date. Nickel up 4% in the week, almost unchanged year to date. And as Keith said, tin down 18% on the week, 5%. I don't know why that happened.
No, and I've tried to find commentary, and the commentary was nonsensical, basically.
Yeah, and then zinc, pretty much unchanged on the week, down a little bit, down 10% on the year. So there's aluminium.
So it fell earlier in the week and bounced in the latter half of the week.
Yeah. Cobalt, copper.
Dramatic.
Yeah. Iron ore. Lithium. Neodymium. Nickel. Tin. And zinc. So precious metals. Precious metals, as Keith said, had a good week. So gold up 7% on the week, 23% year to date. Silver up nearly 8% on the week, 11% year to date. Platinum up nearly 5%, but I don't really know why, unless it's just in sympathy, and 6% year to date. Rhodium flat on the week, and palladium up just 2% on the week.
I should also say that, all these are priced in US dollars. So
Yes.
the fact that the dollar is very good for, their price in dollars.
So we have gold.
Congratulations, Richard. Looking very clever, as is my daughter.
Your daughter is very clever, Keith.
Yeah, she is.
Silver. Platinum. Rhodium. And palladium.
And on to rates. Well, it was an absolutely catastrophic week for rates. So when we reported last week, bonds were behaving in their traditional role as safe havens in market chaos. And last week was an absolutely dramatic week because that totally reversed. Suddenly you had a huge sell-off in the US, and the UK followed, not the Eurozone, as investors completely reappraised their view of the US financial assets as safe havens. And so you had sharp rises in UK bond yields, which hit their highest since 1998, and in the US. Now, last week was one for the history books in the US. That movement in the US 10-year was terrible. And what's really, really interesting is that investors fled the US and moved into the Eurozone. So is the Eurozone, Richard was talking earlier about how the world economy is going to fracture into three parts. China, the bond market is closed and frankly not safe for foreign investors. They are not going to be a safe haven. The US, total economic and financial chaos, where investors putting their money into the Eurozone? Could the Eurozone now prove to be a safe haven? What's also interesting, sadly, is they fled the UK for no reason at all apart from contagion. So the one of our Discord members, Ali Baroid, this week he was in a meeting with Chinese investors, and they were laughing at the US, but they were also saying that the UK is finished outside of the Eurozone on its own. And so the UK needs to tighten its trading relationship with the EU. And hopefully the Labour government is going to do that. Now, although UK long bonds and US long bonds sold off last week, actually longer term inflation expectations dropped because world economic growth is likely to be slower. So, although the UK bonds, long bonds, their price fell, their value, i.e. the real yield you're getting, in the longer term rose. And now, because US inflation expectations are rising and UK ones are not, so the real yield you're getting on US government bonds is actually higher than in the UK. And foreigners still have huge holdings in US government bonds. So if they really were to sell all their bonds, US yields are going to go a lot higher. But contrary to what you may have heard, they haven't sold. What they've done is they've moved out of long maturity to shorter maturity. They've cut the duration because it's chaos and they don't want to take the risk, which is entirely understandable. So this is the UK 2-year. Weirdly, it's up over the last week, whereas frankly, it's much more likely the UK will be cutting rates over the next 2 years because global growth is going to slow. 10-year up sharply, sadly. The 30-year catastrophic. Reminder, I'm in the 30-year, so this whole chaos has been incredibly bad for me. Congratulations to Richard. He was basically betting on the failure of the world economic system, and he's doing well. I was betting the world economic system was essentially self-healing, and I've got totally stuffed. US 10-year, terrible. But in absolute terms, not its highest. It could go a lot higher from here. What's really interesting, the German 10-year. Contrast this with the UK and the US. It's down over the past week. Safe haven buying into the Eurozone. Even France, terrible budget deficit, much worse than the UK's. Italy, the same. Safe haven buying. People are safe haven buying Italian government bonds over UK ones. Greece, the same. And now on to this week's economic data, of which there ain't much. And frankly, the economic data is generally backward looking and it's total chaos. Who knows what's going to happen tomorrow? So we'll try and get through this quite quickly. Richard, the UK.
Thanks, Keith. So UK GDP month on month was 0.5% in February, as we knew with the revision in January upwards. UK GDP year on year 1.4% in February.
I mean, that's actually pretty good.
It is. One wonders how much of it might have been tariff avoidance.
Yes.
Avoidance. So these are shows that all sectors of the economy contributed to the growth in GDP in February. Services, production, and construction, although construction to only a very limited extent.
But production was a big surge, and on your point, is that manufacturers having a lot of orders into the US pre-tariffs?
Yeah.
But the OBR had revised UK GDP expectations for the whole of 2025 to 1.0%. In the first 2 months, we've had 0.5. So, fingers crossed
Well, it would be nice, wouldn't it, Keith, if we could become an economic success story?
Yeah, it would be nice. I'm not holding my breath.
No, precisely. Needs more than 1 month of good data, I think. UK industrial production month on month was up 1.5%, and year on year was up 0.1%. A lot better than expected. UK construction output was up 1.6% in February, as expected, and house prices down in March 0.5%, year on year up 2.8%.
Yeah, so all that there seems to have been a lot of buying ahead of the increase in stamp duty, and now that's come to an end.
Yeah, what a surprise, really.
Yep.
The house price balance is actually quite a lot worse. In March at 2, as expected to be 8, and it was 11 in February. So this looks like the housing market, as Keith says, has been artificially boosted by tax incentives.
Yes.
The goods trade balance was pretty awful, minus 21 billion in February.
Yeah. Frankly, I'm expecting that to get a hell of a lot worse as we get a flood of cheap Chinese imports.
Yeah, and we reduce exports to the US. Okay, the trade balance down was at minus 2 billion in February, was expected to be 1 billion. So that's not great either.
But actually, but although we run a huge goods trade deficit, overall, our trade with the world isn't pretty balanced. That's all right.
Yes. Yeah, agreed. The economic surprise. Now, Keith, this can't be right, can it? The economic surprise index should be like somewhere up above 200 or below 150, and it's like loitering around the zero line.
Well, we did have good GDP numbers this week, so that's good.
I'm just surprised by this. Sorry, I can never resist that dreadful joke. Indeed, job postings continuing their gentle decline.
Yeah, we're now in April. Those national insurance rises have kicked in. Not great.
A UK wage growth 5.7%, so it is falling.
Yeah.
True inflation for the UK at 2.1, 2.2%.
Yeah, this is encouraging, actually.
Yeah, as long as it is indeed, isn't it? And UK GDP was, so in summary, we've got that UK GDP was better than expected. How much was a temporary boost because of inventory building in the US? We don't know. So the UK economy looks like it's being a little bit resilient, but it's not great either. We need to get growth up into the several percentage points, Rachel.
Yes. Right.
We really do.
Yeah, we do. But, on to the EU. So again, very little data. The EU retail sales for February were slightly worse than expectations, but still up 0.3% month on month, year on year. And I never understand this, how you can miss on the monthly and then beat on the yearly. How does that work? But up 2.3% year on year. So that's right. That's the only data point this week. Economic surprise index fading, German job postings actually still on a terrible declining path. French had a little bounce, but a long way down from their peak. Now, the EU runs a huge trade surplus with the US, but around a third of that is due to pharmaceutical exports, mainly from Ireland. And the US is threatening a specific import tax regime, so tariff regime on pharmaceuticals. We don't know what it is, but Ireland, which we reported last week, faces a very low tariff rate because of the current exemption of pharmaceuticals from the tariff regime. That is going to change. So, EU summary, bottom line, the EU is very likely to suffer heavily from US tariffs, tariffs on car imports of 25%, general tariffs of now 10%, but Reminder, the pause in retaliatory tariffs is only for 90 days, he says. On to the US, Richard.
Thank you, Keith. So US CPI month on month was down 0.1% in March. First down month for quite a long time, year on year, 2.4%.
Yeah, all of that should have been great for bonds, but of course it wasn't.
Core CPI month on month was 0.1% in March, lower than expected. And year on year was also 0.1%, lower than expected.
Yeah, great. These are great numbers.
Inflation continuing to fall. And US inflation normally is strong in quarter one, so the weak reading should be reassuring. But of course, as we've discussed, we've got a lot of inflationary pressure from the tariffs and the fall in the dollar. So watch this space.
Yeah. So, Donald Trump has inherited a strong economy with falling inflation, and he has totally messed it up. He should think of becoming a UK politician, actually. We appreciate talents like that.
Yes, Keith. So, specialist statistical methods, i.e. trimmed mean, median, sticky price, and supercore, all falling sharply in the US.
Yeah.
But of course, we don't know what's going to happen next week.
No, that's true. But look at supercore. Kaboom. That is services ex housing. Fantastic.
And excluding shelter, US inflation is now below 2%. So US PPI month on month down 0.4% in March, but year on year up 2.7%. And core PPI down 0.1% in March, up 3.3%. So year on year, PPI is rising. US Michigan consumer sentiment fell off a cliff.
Yeah, no, it was expected to fall. It fell even more.
Yeah, consumer expectations likewise fell off a cliff. Current conditions down sharply, 56.5, and well below expectations. 1 year inflation expectations shot up to 6.7% from 5% in March.
I think this chart's incredibly important because I think this is everything the Fed fears.
Yeah.
So the US is going to have a slowing economy because of the uncertainty, fall in investment, a lack of drop in consumption, rise in taxes, and you'd normally expect the Fed to be cutting rates to support the economy. It can't because inflation expectations are out of control.
And 5-year inflation expectations, basically the same chart, but 4.4%.
Yeah. Now, to counter my earlier argument that rising inflation expectations are dangerous because consumers will react by trying to buy now before expected price rises. Apparently, all the radio stations and bloggers in the US are basically telling the US consumers to pull in their horns, conserve their cash, and make sure they can survive a downturn or chaos. So let's see.
National Federation of Independent Business Optimism Index rose sharply with Trump's election and is now falling equally sharply.
But still actually not bad.
But very much on a strong downtrend. US initial jobless claims, 223, in line with expectations, same as last week effectively.
Yeah.
And continuing jobless claims, very similar, 1,850, so 1.8 million, very much in line with expectations.
But no sign of, recessionary forces.
Indeed, job postings very slightly up and possibly, it's still in a downtrend, but it may be leveling off a bit.
Yeah, agreed.
And link up. I mean, I just wonder what was link up data is really telling us because it. I don't know. I don't know how they calculate their data.
Well, okay, I'll tell you how they calculate. It's the number of job openings from the top 10,000 employers.
Right.
But that's daily. That's monthly. And you notice there's a contradiction between the two. The
Yeah.
last data point is March, but
Mm.
clearly in the daily data, there's not a huge uptick. So,
Yeah.
question.
The Dallas Fed weekly economic GDP 3.1%, up from last week.
Yep.
And GDP now down 0.3%.
Yep, but still up from last week.
Yeah. And the New York GDP nowcast 2.6%, same as last week.
Yeah, and this is the one we like most because it basically doesn't fly around as much as the others.
Yeah. And St. Louis Fed 2.9%, which is a bit up on last week.
So, apart from the Atlanta Fed, the others, in particular the New York Fed, they're not showing a sharp slowdown in the US economy.
No, and they're quite consistent with each other.
Yeah.
The economic surprise index, well, it's like,
Yeah.
I don't know any surprises. So US trueflation 1.5%, a bit down on last week. And this is a decline in foreign tourism to the US, dropped by 13% year on year, and probably got quite a lot further to go.
Yes.
Especially with the stories of the immigration service mistreatment of people.
Yeah, absolutely.
So the US is a big exporter of goods and services. So it has a lot to lose in the trade war. And that's $3 trillion of exports of goods and services
Yeah.
in 2023. And exports to China is 7% of that, or 0.5% of GDP.
And you'd expect that to absolutely collapse now.
And what is the probability of a US recession? Well, I suspect these numbers may well change over the next few weeks, but these are various different sources. If you extrapolate them to the probability of a US recession, you get from nothing to 45%.
Yeah.
And small rise in tax receipts from tariffs in March. So, but this is really going to start kicking in.
Yeah.
Now onwards, isn't it?
Well, you'd think so, but at the same time, I wonder how much there's just going to be a sudden stop while people wait.
Yeah.
125% tariffs on China. Nobody's going to pay that.
Yeah. So this is showing that GDP per capita in the US growth has been outstripping EU and China since 1960. In other words, Keith said, other countries' trade policies don't appear to have had that adverse an effect on the US economy.
Yeah, and Trump is upending a system that made the US consumers the richest in the world.
I think what's happening is he's responding to those, the loss of the car plant jobs and so forth, isn't he? He's responding to that. But of course, those, in terms of GDP, that's all being replaced with other goods and services.
Yeah. But I mean, a lot of these were shitty jobs that working on a production line is really dull work, dull, repetitive work.
Maybe the correct solution is to address the education system.
As a total aside, Richard, I once watched this program, this documentary on people who did incredibly dull jobs. Okay, so I remember one of the women they interviewed worked on the Cadbury's cocoa production line,
Right.
and her whole job was to put the lids into the tins. Okay, that's all she did all day. Incredibly dull and repetitive. And the interviewer saying, how do you enjoy your job? He said, oh, it's much more interesting than people realize. And she said, you see that tin coming down, and there's about 10 away. She said, that one's too small, lid won't fit. And she was dead right. The lid didn't fit. But anyway, that is the sort of entertainment you get on a production line.
I once worked on a production line in my university holiday. It was a real eye-opener.
Yeah. So, and those are the jobs they want back, mate.
Yeah. So, a summary: inflation is soft. Consumer confidence is falling fast. UK economy is still growing. And we don't know, none of these have really been significantly impacted as yet by the tariff turmoil, aka Liberation Day.
Yeah, absolutely. And on to China. So China is back in deflation month on month, minus 0.4%, likely to get a lot worse. All those goods that can't escape from China, they're going to be pushed into the domestic market and into Europe and the UK. It's likely to push goods prices down further. And also, Chinese economy has just suffered a trade shock, a reduction in a demand shock. So it's not going to be good for the economy, bad for inflation. So year on year, inflation was minus 0.1%, below expectations. PPI, input prices still falling, down 2.5% year on year in March, below expectations. That's it. China is still in deflation, and the Chinese economy will undoubtedly suffer from tariffs in the coming months. Okay, onto one chart. The economic system that Donald Trump is currently disrupting was very good for US assets because the US ran a huge trade deficit, and so that meant it was giving US dollars to foreign manufacturers, and those foreign manufacturers would then use those dollars to buy US financial assets. And so this is the change in foreign ownership, in the ownership patterns of US assets, financial assets, since 1945. And you see the rest of the world has increased massively its holding of US financial assets over that period. Now, the danger for the US is that as it reduces the flow of dollars out of the US, so it's reducing the flow of foreign money into its bond and equity markets. And so the natural effect of that will be higher bond yields as it runs massive fiscal deficits, and it's just removed one source of demand. Watch this space. Okay, so let's talk about the legality of what Trump has done, because he's imposed all these tariffs without recourse to either the House of Representatives or Congress. So the legal basis on which he imposed tariffs on Mexico, Canada, and China was as a national emergency due to the extraordinary threat posed to the US by illegal aliens, drugs, and including fentanyl. And he legally justified his actions with reference to the International Emergency Economic Powers Act passed in 1977. So he declared a national emergency. Now, the reciprocal tariffs, he also declared a national emergency. Quote, underlying conditions, including a lack of reciprocity in our bilateral trade relationships, disparate tariff rates, non-tariff barriers, and US trading partners' economic policies that suppress domestic wages and consumption, as indicated by large and persistent annual US goods trade deficits, constitute an unusual and extraordinary threat to the national security and economy of the US. Now, notice there's nothing immediate in that. There's nothing that constitutes something that's crystallized a national emergency. But he again used the International Emergency Economic Powers Act, the National Emergencies Act, and the Trade Act to enact his tariffs, again not going through Congress or the House of Representatives. So, can he do that? What is the definition of a national emergency? Well, the International Emergency Economic Powers Act operates within the wider remit of the National Emergencies Act. Unfortunately, neither of them define what constitutes a national emergency. They give the president very wide powers to define what constitutes a national emergency. And the National Emergency Act grants the president extensive powers to regulate a variety of international economic transactions during a national emergency. Congress has no powers to revoke a national emergency, and because the National Emergency Act, does not define a national emergency, it would be very difficult to challenge it legally in court. Now, there's a precedent. In 1971, Nixon used emergency powers under the Trading with the Enemy Act, which was a predecessor to the International Economic Emergency Powers Act, to impose 10% tariffs on all imports. Those tariffs were challenged in court, and the court ruled that the broad powers under the Trading with the Enemy Act allowed the president to regulate imports, including through the use of tariffs. Now, the International Economic Emergency Powers Act replaced the Trading with the Enemy Act, but the courts have continued to use the interpretation of the Trading with the Enemy Act to interpret the International Economic Emergency Powers Act. And so any challenge to Trump's tariffs is likely to meet the same response to Nixon's tariffs, i.e., he's the president, he can do it. Pause, take a look. This is the legal basis that the Trump administration has used as a justification for its tariffs. You notice that the tariffs on Canada, Mexico, and China have a 4-year expiry unless extended. So could its trading partners take the US to the World Trade Organization to get Trump to reverse the tariffs in international law? Could they use international law to cancel these tariffs? Well, in 2018, when Donald Trump last imposed tariffs, he justified steel and aluminium tariffs with reference to national security. The WTO subsequently ruled that the tariffs could not be justified under the security exemption, and it's very likely the WTO would rule similarly in the current case. But the US simply disagreed with the WTO and appealed it into the void, is the term I've heard used. So they simply ignored it. And if they were trading partners to appeal to the WTO, it's likely they would be unable to enforce any judgment. They could get a moral victory against the US, but not a reversal in the policy. So conclusion. Under US law, the Trump tariffs are probably legal and therefore very hard to challenge. Under international law, trading partners might get a symbolic victory at most. There's no alternative but to negotiate, sadly. Now, can the tariffs be challenged domestically? Congress can act to stop the tariffs. The tariffs have been implemented using presidential executive orders. Neither Congress or the House have voted on them. In order to stop the tariffs, Congress has to pass a resolution of disapproval, which would terminate the national emergency and therefore the tariffs. Now, the Republicans currently have 53 seats in the Senate. The Democrats have 47, including 2 independents who tend to caucus with them. So, in order for Congress to pass a resolution of disapproval, you would need 3, possibly 4 Democrats to cross the floor. But it's worse than that, because if they were to pass a resolution of disapproval with only a simple majority, the president could veto the motion and stop it coming into law. So, in order to get a resolution passed that the president couldn't veto, they would need to pass a resolution with a 2/3 majority. So you'd need a lot of Republicans to vote with the Democrats. Now, there's already been an attempt to pass a motion of disapproval in the House of Representatives, which failed despite 3 Republicans crossing the floor to vote with the Democrats. The Senate will vote on a resolution of disapproval when senators return from Easter recess on April the 28th. Now, 4 Republican senators had previously helped the Democrats pass a disapproval resolution related to the Canada tariffs. So, again, it suggests the resolution could pass, but without the 2/3 supermajority to get past a presidential veto. Bottom line, tariffs can be overturned by Congress, but only if it passes a disapproval bill that passes with a 2/3 majority. That would require roughly 1/3 of Republicans voting with the Democrats. We're a long way from that. Bottom line is the barriers to reversing this policy legally can't be done. Politically, it can be done, but the barriers are extremely high. Chaos would have to get a lot worse. Be prepared. Richard, your thoughts?
That's interesting, Keith. The US, as a generality, at some point will be ruined the day that they didn't put sunset clauses into these various bills, so that they gave the president the power they thought the president needed to do a particular thing for a couple of years, and then basically they expired. And that's sort of what's gone wrong, isn't it? There's been this, sort of, as you mentioned earlier, there's been this progressive creep in power, by presidential power, without the inability to sort of control it appropriately. And I guess what they should actually do is they should sunset all of these and start again.
Well,
if they can't do it under Trump.
Well, your wider point, Richard, is basically the checks and balances in the US economy just aren't working. They give the US far too much presidential power. And the US system has thrived on this system of checks and balances, the independent judiciary, etc. But Trump is acting like a tyrant, as we spoke earlier. And the barriers to reversing the policy are incredibly high. It's going to have to get a lot worse before it gets better, before he's either removed from office or these policies reversed. And frankly, that's what I expect to happen. I think it's going to get a lot worse.
Mm. They do need to sunset all these powers, because otherwise what will happen is the next president, whoever he or she may be, will come in and basically, maybe not in a direction of tariffs, but they have the ability to do it in any direction they take the whim to do so. And so actually, the destruction of the US democracy is twofold. It's the funding system, and it's the ability, the continual accretion by the president of powers that basically enable him, as you say, or her, to act as a tyrant.
Okay, so thank you to Mr. C. Peckham for getting in touch and for suggesting this topic. How much would it cost to make an iPhone in the US? Answer: it would cost between $30,000 to $100,000 each, if it's possible at all. And this is not for the reasons you think. So the main issue is not labor costs, it's supply chain and lack of critical skills. So this is the cost of if everything had to be made in the US. The big problem is critical skills. So according to Tim Cook, who actually has been specializing, the reason he became CEO is he'd been working with Chinese manufacturers for 25 years and is an expert in the supply chain, basically. According to Tim Cook, the US lacks key manufacturing skills, particularly in tooling engineering. Now, what is tooling engineering? It is the field that focuses on designing and developing the tools used in the manufacturing process to produce parts or components, i.e., it's producing jigs, dies, and cutting tools. And tooling engineers are highly skilled, highly trained, and need to combine artisanal craftsmanship with precision engineering. And I'm going to read this out from Tim Cook. There's confusion about China. The popular conception is that companies come to China because of the low labor cost. I'm not sure what part of China they go to, but the truth is, China stopped being the low labor cost country many years ago, and that is not the reason to come to China from a supply point of view. The reason is because of the skill and the quantity of skill in one location and the type of skill it is. The products we do require really advanced tooling, and the precision that you have to have in tooling and working with the materials that we do are state of the art. The tooling skill here is very deep. In the US, you could have a meeting of tooling engineers, and I'm not sure we could fill the room. In China, you could fill multiple football fields. And so decades of manufacturing being outsourced to China has produced a deep skill set, which would be very difficult to reproduce in the US quickly. It would take a long time for the US to develop the skilled labor force needed to fully reshore iPhone production. The problem with tooling engineering is that it requires lots of on-the-job training, i.e. training by doing, learning by doing, and that is very difficult to shortcut. You need to make mistakes, learn from those mistakes, and correct them. But that's only part of the problem. The US would also need to recreate the whole component supply chain that it currently lacks. It would need to improve its infrastructure. It would need to improve its logistics infrastructure, and it would need to recruit hundreds of thousands of workers to do tedious, repetitive work on the assembly line. That even if you used robots and automation. Bottom line, in the best case scenario, forcing Apple to manufacture iPhones entirely in the US would result in production falling from hundreds of millions a year to a few million a year at much higher cost. But that's not what would happen. What would happen is the cost of iPhones would become prohibitively expensive and people would switch to other brands, or the industry would die. If you tried to fully reshore iPhone production, you would kill Apple. And hence, that's why they have removed the tariffs temporarily. But imagine that the supply chains, the skills, the labor were all available. How much would just reshoring production to the US add to the cost of the iPhone in labor costs alone? Yeah, so this is data for the iPhone 7. Bottom line is, if you think that components prices are unchanged, the only thing is the cost of the labor in the assembly process. The only difference between China and the US. It takes around 20 hours of labor to assemble an iPhone. Chinese wages in 2025 are around $3.70 an hour in manufacturing. In the US, they're 29. So work it out. Just the labor alone in the assembly process would mean the cost of an iPhone going from $345 produced in China to $851 produced in the US.
So I think what Trump is doing, as I said, he's throwing everything up in the air and seeing how it all lands. And you know, whether you believe that to be a good thing or a bad thing, that's what he's doing. And his strategy is, when it all lands, you take the action to mitigate the problems, and where you've got a benefit from doing it, you take that benefit. So it's sort of the big picture is, I think he says, fine, then so now we understand that. Now I understand, because other people always understood it, that this doesn't work, so therefore we amend that. And I think that's what he's doing. He's just throwing it all in the air to see how it lands. So, and that is chaotic, completely chaotic. But it also, I suspect, as you pointed out, that's why tariffs have suddenly dropped back down on the importation of electronic components. That's his response to saying, "Oh, this one doesn't land very neatly." But my suspicion is that they're all going to land like this, because actually the US economy is pretty much optimized.
Yeah.
Therefore, after all of this, nothing very much will change, because it all lands in the way of, well, we can't change that, can we? Because we'll screw ourselves.
Well, I hope you're right, Richard. But to a reminder, so on Saturday, they suspended tariffs on consumer electronics and computers. Then on Sunday, Trade Secretary Howard Nuttall comes out and says that the suspension of the tariffs is only temporary while they prepare a regulatory tariff regime for electronics. So they're not backing down. They're just saying they're backing down temporarily, but they're
Yeah,
not
but
changing the policy.
I agree. On the face of it, yes, but underneath, I'm not convinced. I think Trump will move any way that he sees as advantageous, and he doesn't.
Yeah.
He doesn't care. I think he enjoys all the sort of the talking heads in the New York Times and I think he loves that sort of stuff because basically he's got everybody dancing to his tune. I don't think he cares about any of that. I don't think he's bothered about loss of face because to him it's not a loss of face. I think he just goes through and does this stuff and ultimately, I suspect after all the shouting and all the chaos that ensues, we'll sort of get back, roughly speaking. This is my bet, roughly speaking, to where we were before, having gone through a whole deal of turmoil and angst, and it will cause problems and so forth. That's just my sense of where we're going.
Well, he's going to cause lasting damage to the US economy.
He is, yeah, no doubt.
Because bond yields are not coming down, not going back to where they were, because there's going to be a risk premium now attached to the US under his presidency.
But I think that, my point is that I suppose that none of one can do all sorts of analyses, but the whole thing is not definitive because he will change it.
Yeah.
And
actually, on your point about Trump, Richard, I watched a short piece by the comedian Bill Maher in the US, who has been a consistent critic of Trump. And so Trump invited him to dinner.
Mm-hmm.
And what was really interesting is that Maher, who's been, very critical of Trump, found him to be actually quite charming, welcoming, had a sense of humor, could laugh against jokes against himself. And he said, there are two Donald Trumps. There's the Donald Trump in private and the act you see on TV. So he's playing a role. So it's not like he's, as deranged in private as he is in public.
I actually think that there's so much knee-jerk response to what he does that it's like, and everyone's sure, shock and awe and horror and so forth, and it's a bit like just let him get on with it and see how it all settles down. That's my sense of what we have to do, because this is a very nice analysis of the cost of creating an iPhone in the US. Clearly, it's not going to happen.
No, it's not.
So it's great you could do the analysis, but having done the analysis, say, well, that's not going to happen, and it's not going to happen.
No.
So it's sort of, but it's part of this sort of, my God, this is all horrendous and dreadful, and actually, it's not going to come to pass.
No, I totally agree with that, Richard. But I think there will be some tariffs at the end.
Yeah.
And there will be a lasting chaos premium charged on US financial assets. Now, when you talk about how the other countries are responding, I think the way the EU and the UK are responding is really good. So they've actually removed tariffs, they're being calm and they're waiting back. But in my discussion right at the start of the podcast, where I was saying this suits the CCP, I think it does. Them pushing back hard, that's great. They have an external enemy to unite the country against.
And what he is doing, as you say, is he's removing the US to an extent from the international system, and he's making the US a much less reliable ally. And that is not reversible, or at least it's not reversible in the short term.
I agree.
So,
and while we're talking about trade, let's quickly talk about the cost of the US bicycles. So Kent International is a big US bicycle manufacturer and retailer, and this is a shot from its website. Now, how are tariffs going to affect Kent International? Well, it's warned they will have a severe impact on its business. Most bikes are manufactured in China, Taiwan, Vietnam, and Cambodia. They are saying prices across the industry may rise as much as 50% due to import tariffs. Kent International has already raised prices by 12.5% this year after the first round of tariffs, during which Trump enacted 20% tariffs on China. And reminder, they're now 145% off. Anyway, they're vast. It expects sales to drop to their lowest in a decade as bicycles become too expensive. Now, in 2014, it established a factory in South Carolina to reshore some manufacturing jobs, but that factory assembles imported components, and so it will be hit by tariffs. The mood in the industry is grim. It's facing a potentially existential threat. So, on Richard's point, something's got to give. Otherwise, much of the US bicycle retailing manufacturing sector disappears. The trouble is that if tariffs were imposed in a gradual manner, the industry would have time to adapt. When you go from 0 to 145%, then it has no time to adapt. It's like the evolutionary process is too extreme. You can't develop the entire US supply chain in that time. It takes time. And so it will either die or the tariffs will have to come down.
I completely agree. And I feel so sorry for that small business that imports aluminium parts from China. Suddenly got to pay, 75% of the cost, an additional goes as tariffs. I mean, you can't run a business on that basis. And the trouble is that even if he then walks it all back, he would have imposed huge damage on the US economy in a short space of time. It's a very foolish policy, but I think that's what he's doing.
Yes, well, I agree. Okay, so this week we've seen a big sell-off in bonds. Now, lots of market commentators are saying that is because of an unwinding in the basis trade. Now, what is the basis trade? So this is US Treasury bond yield, which did not have a good week. That is an absolutely extraordinary spike for what should be the global safe haven asset. Clearly, it ain't no more, thanks to Donald Trump. So, what is the basis trade? Well, essentially, it is arbitrages the difference between the future and the Treasury bond. So, the way most investors gain exposure to the Treasury bond is actually via the future, because you only have to put down a small amount of collateral. So you buy full exposure, $100 worth of US Treasury exposure while only putting down, let's say, $10 of collateral. So as a result of that, the future tends to trade at a premium to the underlying bond. And hedge funds essentially arbitrage the difference between the future and the underlying bond. That is the basis trade. Now, the reason it is dangerous is they do it with absolutely enormous leverage. Now, key points about the basis trade. Funds borrow short in the overnight market. So spikes in borrowing costs in the overnight market are bad for this trade. Most of the positions are in longer maturity treasuries at higher yields because the difference between the future and long-dated treasuries are greater, so there's more to arbitrage. Financing is in the repo market, so disruptions in the repo market are bad for this trade, and leverage is typically between 5 times and 20 times. So profit depends on the cost of funding and the spread between the futures and the underlying. It is not risk-free. And its enormous size. So hedge funds are short 800 billion of treasury futures. And they have big positions in the 10-year. So 10 years sold off hard this week. Now, the danger is a margin call causes this trade to unwind quickly. And what has happened this week is that increased volatility means that the futures exchanges and repo exchanges have demanded more margin from hedge funds. That means they need to stump up more cash or they need to cut the size of the trade. And so they've cut the size of the trade, resulting in forced selling of the underlying, i.e. the physical bonds and purchases of the future. Now, who's buying all those treasuries they're trying to sell? Well, the main counterparty is broker-dealers, but they are also capital constrained and can't absorb unlimited selling, therefore prices fall. As a result, volatility spiked, and this last happened in 2020. The start of the pandemic, there was a dash for cash by international investors who sold their most illiquid assets, including treasury bonds. This in turn put pressure on hedge funds who were forced to liquidate their leveraged positions in treasuries. Treasury yields spiked, threatening a financial crisis. It was solved by the Fed ultimately stepping in to buy an astonishing 1.6 trillion of bonds in a month and calm the markets. Now, this is what happened in 2020. You'll see there was a big spike, particularly along longer ends. That's the red line is 30, orange 20. The blue line is the 10-year. But the Fed acted to calm yields. Yields medium term did not come down much, but it spiked. It calmed the market. Liquidity in the treasury market is actually okay, though, not showing particular signs of distress. So I am skeptical that it's the unwinding of the basis trade that has caused the spike in US Treasury yields this week. I think it is systematic selling rather than a technicality on the rather than hedge funds liquidating their position. I think everything we've seen is that foreign investors and governments have been selling US long bonds to buy the shorter end, cutting their risk.
So is US manufacturing really declining? As Trump would have us believe. So this is the manufacturing share of US employment, which obviously has been declining since the end of the Second World War, from 30% down to 8 or 9%. And the manufacturing share of nominal GDP, likewise, it's declined from around about 28 to 29% down to 12 or 13%. This is up until 2015. And manufacturing share of real GDP has stayed pretty constant, hasn't it? From 1947 until 2015, didn't really change by very much at all.
Yeah. So what it's saying, Richard, is that when you look at the quantity of goods produced in the US as a percentage of overall value of all goods and services, then it stayed pretty constant. So the US manufacturing sector continues to churn out a load of goods, but what's changed is the relative price. So what we're saying is the quantity of manufactured goods produced in the US as a percentage of real GDP has remained fairly constant over the last 50 years. Its decline in importance as a share of nominal GDP is because the relative price of manufacturers has not risen at the same pace as the rest of the economy. Therefore, manufacturing as a percentage in price of the GDP has fallen, but not as a percentage in terms of quantity. So what's really happened is you've had huge productivity growth in the manufacturing sector as a result of automation and, to a certain extent, offshoring. Most of the jobs lost in the manufacturing sector have been lost to automation.
So the solution there fundamentally has to be an educational solution, doesn't it? To enable people to work in other sectors.
Well, I don't think people. Yeah, go on.
Well, because in the US, there are areas that have been eviscerated economically by the loss of manufacturing jobs.
Yeah,
Detroit, for example, and which is partly what Trump is responding to. Why he was elected, and so, but so there has to be a solution to that.
Yeah, but I mean, the thing is, what's happening in the US is, I mean, everywhere in the post-industrial age, is that you get areas of blight where, there used to be big industrial centers which used skilled or semi-skilled labor, and the whole of the economy has moved much towards service sectors and highly skilled service sectors, and those areas which were former industrial areas are just left behind and obviously are politically very unhappy.
Yeah. So the problem for the economy, same as the problem for the UK economy, is how do you address those, as you call it correctly, areas of blight?
Mm.
And clearly, imposing tariffs isn't the answer.
No, it's not.
So
do you want to do an intro?
So a little bit of technology news here. We are going to have a look at Chinese EV and batteries. So BYD has unveiled a battery charging system that claims will add 400 kilometers of range in 5 minutes, and it has an amperage. Well, it has a power rating of 1,000 kilowatts. I don't know what voltage it does that at. So, and so they claim effectively that you can charge your car up to achieve, actually, I think, greater mileage, greater distance in just about the same time it takes you to fill a tank of petrol.
Yeah.
Which would be a game changer, because range anxiety sort of disappears as long as you can find a charger that can handle 1,000 kilowatts.
I mean, 1,000 kilowatts is just enormous. That's like over 100 kettles. The power.
Yeah, and the grid isn't set up. Our grid is not set up to deliver that sort of charging on a large scale. And I say, I don't know what the voltage is, but I'm guessing the voltage actually is quite low, and therefore the current,
the amperage must be enormous. Now, one thing I didn't know was that the lithium-ion batteries are amazingly efficient at storing charge. They have a Coulombic efficiency ratio of over 99%. That's, i.e., the electrons going in, 99% of them are stored.
No wastage there.
Yeah.
So they also unveiled a new lithium-ion battery construction, claiming that it's much safer and doesn't suffer from thermal runaway. So this new battery is resistant to overcharging and crushing, bending, and heat exposure, whereas, as we know, the current lithium batteries, they have a volatile solvent, don't they? And the solvent catches fire, and then the thing is virtually impossible to put out using conventional fire extinguishing means. You just have to let it burn itself out. So that's really interesting.
Yeah, absolutely.
Is this the same one that can be charged at 1,000 kilowatts?
I'm not sure. I think because this is actually the structure of the battery they're changing.
Yeah.
So, it's the same company. Perhaps it is.
Well, what we can say is that battery technology is developing very, very quickly.
And mainly in China.
But not to worry, because we can tariff them out of existence. So this, to me, looks like a quantum computing chip. And quantum computer D-Wave achieved quantum supremacy by calculating the transverse field Ising model problems, which is quantum, sorry. Read the technical stuff there.
Yeah, exactly.
But basically, it's, I think we have to wait and see, really, because a quantum computer is fantastic. So it produces a beautiful picture, isn't it, of a quantum device, but presumably it needs to sit in liquid helium in order to function, because they are so vulnerable to external energy influence. So, but they look beautiful when they're photographed like that, but it doesn't work quite that way. Anyway, I think we're a long way off having the sort of quantum computing that people would like to see, but I'm sure we will get there eventually.
Yeah, so I'm just the thing is, this is so close to science fiction for me. I just don't know what to believe.
Yeah.
So every time one of these quantum computing companies comes out with, oh, we've done it, we've changed the world. The next thing that comes out is, so new scientists have since reported that two separate groups have replicated the same calculation on a laptop. So, there's so much hype in this thing.
Yeah, of course, D-Wave is a commercial enterprise that needs to keep its share price up so it can issue more shares so that it can continue in existence.
Yeah.
And fair enough. That's what they do. And we live in a capitalist economy. But I mean, Microsoft announced that they had achieved their topological quantum computer, didn't they? But when you dig beneath the surface, it's not really.
Yeah. They're basically
what they say it was.
Everyone pushing back immediately, saying, they haven't actually done it.
Yeah.
So we will be doing our technology watch, a few times a year when, something interesting comes up. And on to inflation watch, Richard.
Thank you, Keith. So we've got UK CPI was down in February to 2.8%, and the core was down to 3.5%, RPI down to 3.4%. So that is good news to UK. US inflation we've already covered. EU inflation was basically 2.7%, 2.8% for CPI and core CPI. Japan and falling Japanese inflation 3.7% for CPI, which is really quite high, but falling at 3% for core CPI. And then Chinese inflation was actually negative in March at minus 0.1%. Core CPI was up at 0.5%. So UK still got interest rates at 4.5%, and the US is still at 4.25, 4.5. The EU actually still at 2.65%, which is a very low rate in my view.
And notice that Swiss bond yields are negative again.
Yes.
Yeah. So, and the world has just we are experiencing live a demand shock.
Yeah.
So that is going to be, all else being equal, that should bring inflation down.
Yeah.
Apart from in the US, where they are self-imposing inflation through a tax rise.
So March manufacturing PMI is showing the US is facing this combination of high and rising input price pressure, and it's a real outlier. Well, we've talked about it a lot.
Yeah.
Container freight prices falling, possibly even in anticipation of trade volumes falling.
Well, it's only going to get worse.
Yeah. And manufacturing PMI input prices, you can see the US is soaring away there. Everybody else is reasonably flat, actually, but the US suddenly soaring up.
Yeah.
This is China obviously think that there's going to be significant inflationary pressure in the US from this rather clever cartoon.
Yeah, absolutely. And that's China's Ministry of Foreign Affairs, and they're absolutely dead right.
So what have we got? Well, as we've discussed, tariffs mean US inflation, assuming that they stick, which we've talked about a bit as well. Would be inflation in the US, and the rest of the world inflation will fall because of lower oil prices and the diversion of Chinese manufactured goods to other markets. So the world is in turmoil.
Yep. And on to recession watch. Actually, Richard, I've talked a lot. Do you want to keep going?
Yes, okay. So even without the recent policy uncertainty in the US, there are signs that the capital investment cycle in the US had run its course. And now what we would expect to see is no capital investment really until the fog clears and people actually know what's going on in the US economy. So you would expect capital investment in the US to decline dramatically over the next
Yeah.
few months.
Well, previously, the US has benefited from all the reshoring and tech investment incentivized by the CHIPS and IRA Acts under Biden, and
Yeah.
that surge was already fading. So that's bad for growth.
Yeah. So mortgage default rates in the US are high and rising, and this is a chart of serious delinquencies in multifamily apartments, but basically it's higher than it was at the height of the GFC.
Yeah.
6 million US citizens are behind on that's really properties, isn't it? 6 million
Yeah.
properties behind on their mortgage. Not great. And pandemic excess savings have been spent effectively by the majority of US households,
And
apart from the rich.
apart from rich.
US business confidence falling fast, and travel, as we discussed earlier, travel to the US and port activity both declining. So it's going
Yeah.
to
I
hit
thought,
tourism to the US.
yeah, I thought the port activity, this is not what I expected. I would have thought port activity would have gone through the roof in February and March and then started to fade now.
Mm,
So that's odd.
yeah.
That suggests the inventory build was much earlier.
It does, doesn't it? The inventory build-up occurred before Trump's inauguration.
Yeah.
Bankruptcy filings highest since the pandemic and spiking up very sharply. JP Morgan's credit card loans marked as irrecoverable, now at 3.5%, rising sharply. Although that rise is actually about 2 years old now, but so continuing that trend that started in mid-2022. Percentage of loans in all US banks deemed irrecoverable is higher than the pandemic. Not excessively high yet, but it's got a way to go before it starts to get significantly above that sort of baseline of about 1. And the European visitors to the US falling sharply because of all the adverse publicity.
Now, we were talking earlier about the US inflation numbers in March coming in very soft.
Mm.
You wonder how much there must have been a drop in demand for very price sensitive sectors such as hotels and airfares.
So as we have discussed sort of US recession and so forth for years, as regular viewers know, but I think the last few months we concluded that US consumers were showing signs of exhaustion, and but I think obviously there's this huge uncertainty now, and
Yes.
we'll see, won't we?
But reminder, all the nowcasts are showing the US economy doing just fine. It's the economy is a super tanker. It will take a while to turn. On to good news. And you need some after all that. And frankly, this good news is just entirely gratuitous because I like the photo. So this is a record 736,000 sandhill cranes have visited Nebraska during their spring migration. And that is a hell of a lot of sandhill cranes, and shows actually, because this is a migratory bird that travels the whole of the continent of the United States, that actually the bird population is not doing as badly, well, certainly the crane population is not doing as badly as you might expect. So that is very good news.
Good news.
And concluding comments. So total chaos. The US is in the process of destroying itself as a global safe haven and as the country where as the global risk-free rate. Richard, your thoughts?
Well, yeah, it's chaos, isn't it, Keith? I think we're going to have to wait some time, as we've discussed during the podcast, see how it falls out. I think people should be in safe assets. I certainly wouldn't be buying any bounce in any stock market, and I would be very wary of actually making any move, particularly just sit and watch what happens. I think we may be at the start of a long-term bear market.
Yeah, I'm entirely with Richard. Cash is king. Cash and gold are kings, basically. You don't want to be taking any risk in anything because, frankly, I'm expecting much more volatility.
Yeah, I think
and
that's
so I've got this totally wrong. But the thing is, I see, although the price of my UK bonds has fallen, the value, i.e. real yield, is rising. And the 30-year, you're now getting the equivalent of 7.3% tax-free. So you would have to get, as a high rate taxpayer, you'd have to get 7.3% to match the yield risk-free on UK government bonds. And so I've lost a lot of money, and I'm not going to, obviously you all know I'm looking incredibly foolish, but essentially I've locked in prices that an income that I can live the rest of my life on. So not looking very clever, but at the same time, I'm feeling remarkably, I would say relaxed, but actually might be numb. So anyway, on that note,
Yeah.
thank you all for watching. Another hugely long episode. The next one will be in 2 weeks' time. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.